Let's do some calls of the day. We're going to start with JPMorgan. Was downgraded to peer perform today at Wolf. They removed their $216 price target, de-risking on rate cuts and a slowing economy. Kind of what we've been talking about here. Jimmy, you want to go first on this?
Yeah, I think to the extent that you see any economic growth going forward, you know, the infrastructure spending, build data centers, supply chain onshoring, all that sort of stuff, it needs financing. So unless you're going to be totally out of the financial sector, I think you own the creme de la creme, which is JPMorgan. I mean, you can quibble with its valuation on a book value basis, fine, but on an earnings basis, a dividend yield basis, I don't think you're going to quibble with it. By the way, all this with capital markets still kind of frozen, maybe quasi-thawing, but still feeling kind of frozen. I don't think you sell JPMorgan here.
Joe?
That's really well said, and I think when you look at this company, you realize how much they benefited from the stress in the regional banks in the first quarter of 2023 and how they benefited from deposit inflows. Now, where are they now? What are we expecting as we approach earnings? You're going to hear a lot about regional banks that are going to be increasing their share buybacks as we come off the stress tests. I don't think you're looking at JPMorgan and saying to yourself, we're going to get this remarkable increase in the capital allocation strategy that's going to motivate me to go in and buy the stock, or the stock's going to appreciate significantly. But I do think what you're going to see is a very strong quarter surrounding fees. And you're going to have that strong quarter because you have a strong market. So therefore, this company, who's positioned so well in wealth management, in investment banking, should benefit in that regard. I would expect a very strong fee-related quarter.
Can you buy it here? Can you buy it here?
Yes.
For me, no.
Even up 21% year to date, you can buy it here.
No, not me.
Yes.
Not when I can get 1.2 times book at Bank of America. Not when I can get 10 times earnings for Morgan Stanley, especially in the capital markets piece. But what I do think we're going to hear this earnings season is not so much this quarter net interest income and net interest margins do well. I think it's going to be the guide, because look at the yield steepening. That's a good thing for them. And so I actually think, yeah, investment banking fees for sure. Equity capital markets, debt capital markets, good. But I think it's going to be that piece, that net interest income piece. And JPMorgan has like a great track record of raising their NII on a consistent basis.
All right, let's do ServiceNow, because it's not often you see a sell call on the street. You did get one today on ServiceNow from Guggenheim. Price target's at 640. It's at 770, is what we'll call it. 2020, second quarter of 24, fine, but future risks don't match the valuation. You want to take this one on?
Sure. So at the end of this month, we will rebalance the ETF. We'll take a look at this company. What I could tell you about it is it has a very strong near-term momentum. It's up 17% since May 31st. Bill McDermott, CEO, has done a remarkable job navigating this company over the last several years. This is going to all be about, when they report on July 24th, what's the top line subscription revenue? What's the guidance for top line subscription revenue? Now, the analyst is to call into question that guidance might be weak. Why? Because we're seeing an environment where IT spending is beginning to moderate, and that is impacting a lot of these software companies. I don't think ServiceNow is going to ultimately be immune from that, but I think you have to have a wait-and-see approach. What's going to happen on earnings? Would I buy it here today? No, I wouldn't.
I mean, when you're first...
I wouldn't buy it here today. Would not buy it here today.
I got you with that. I knew that when you used the R word, or the very first part of your answer. The rebalance. You mentioned that. I mentioned the call. You said, well, we got the rebalance coming up. I mean...
We'll take a look at it. The momentum over the last 6 weeks has been remarkably strong. So again, if I'm doing the checklist, strengths and weaknesses, that's a strength up against what has been some weaknesses related to IT spending.
Steph, Schwab upgraded to outperform the KBW price target to 84.
Yeah, I mean, it's a laggard, and I actually recently added to it because it has been such a laggard. But I think this whole cash sorting thing it's had its day, and we're also now starting to see a decline. In addition, NNA, net new asset growth, is running around mid-single digits, a little below their guide of 5 to 7%. I think they can get there, and I do think as their free cash flow improves because of the cash sorting situation, they'll be able then to return to their buyback program. And I also think the Ameritrade acquisition is very attractive and gives them a lot of cushion on the earnings themselves. So I like it.
You want to talk about Seagate too, which got the price target bumped by $15 at UBS. I mean, they don't really love it here, right? It was reiterated neutral. but you did buy it recently.
I did about a month ago, and that's after Dell reported good numbers in terms of green shoots in their PC business. HPQ said the same. AMD mentioned that earlier in terms of how powerful their new chips are going to be, and that is going to lead to a refresh cycle. This company is the leader in the industry. It's really not that expensive, about 18 times forward estimates. So, by the way, they've got huge pricing power. Their margins could go from 26% to mid-30s this year, which would be huge operating leverage to the bottom line.
Union Pacific was initiated overweight. 273 is the price target. That's a pretty big upside from here by Stephens.
Yeah.
Now, you own the stock. Does that call make sense to you, given your own view on the economy?
Well, I mean, I have to qualify that my own view on the economy is data dependent right now. I mean, I'm being pretty naked about that.
No, but I know, but you said you're more nervous than you've been in years. Now, if you didn't own this stock, let's take it out. I feel like you're going to give me a biased answer.
I'd wait, and let me give you a different answer, right? If I get to the end of this week and I'm nervous, Scott, Union Pacific's on the chopping block. I mean, this is about as economically sensitive a stock as you can possibly imagine. I guess I'm supposed to take some comfort from the fact that it's been about 3 of these upgrades in the last week, and we've kicked them around. Stock's not responding. I mean, the stock is data dependent. This is moving stuff on rails. I don't care whether it's intermodal goods that people aren't buying stuff right now, or manufacturing plants, which should be reflecting but isn't in the stock price. He's
a rock star CEO, though. He'll make you money.
I
over the long term, he's a rock star.
Completely agree, but he cannot fight.
Understood.
If we get your 2%, fine, I'm with it. If this weakens, and Atlanta Fed, as you know, right now is at 1.5%, and if that's the trend we're going to, Union Pacific's on the chopping block.
Why is it down 9% year to date?
Because it's all the last 3 months when the macro situation deteriorated.
Most of it is the last 3 months.
When the Citigroup U.S. Economic Surprise Index 3 months ago started falling over, so did Union Pacific.